All right, let's dive right into this explainer. Today, we're not just doing a post-mortem on a corporate failure. We're breaking down how the May 2026 liquidation of Spirit Airlines actually became the ultimate market catalyst for its legacy rivals. Now, historical data shows us that bankruptcy plays like this have about 45% higher viewer retention, and there's a good reason for that. People are fascinated by them. But here's the thing. They are almost always fundamentally misunderstood by the public. So today, we're going deep into the data, the exact timeline of the collapse, and exactly why this single event triggered a massive, permanent shift in the aviation sector.
So, we need to move past the dramatic mainstream headlines to uncover the hidden alpha in this massive industry shakeup. Spirit Airlines just vanished? For budget-conscious travelers, yeah, it is undeniably a literal nightmare. But for three specific airline stocks, it is arguably the greatest gift of 2026. Instead of just saying RIP Spirit and moving on, we really need to analyze the survival plays, specifically the liquidity moats of carriers like JetBlue, United, and Delta. We're looking at a classic bear-to-bull transition for these surviving competitors. But to really grasp the windfall, we first have to understand the sheer scale of the destruction. 17,000. That is the staggering number of jobs lost overnight on May 2nd, when Spirit officially ceased operations after 34 years in the sky. We are talking about 14,000 direct employees and thousands more external contractors. It's literally one of the largest single-day mass layoffs in the history of U.S. aviation. Just to put that into perspective for you, that is the equivalent of an entire mid-sized town losing its primary income source in a single afternoon. The human cost here was immediate and profound, creating a massive economic dislocation, especially down in South Florida, where the company was headquartered and ran its primary hub. And along with those jobs, 3.4% of total domestic flights instantly evaporated from the U.S. aviation market, just leaving this massive void. Think of it like someone suddenly shutting down an entire lane on a major congested highway. 3.4% might sound like a pretty small single-digit number, right? But in the highly interconnected infrastructure of domestic travel, erasing 200 to 300 daily flights across 40 cities creates an immediate cascading shockwave. So how did a major carrier reach the point of total evaporation so fast? Well, we have to look at the timeline that completely shattered their razor-thin business model. Let's get into part one, the macro shock and assumption brittleness. What financial analysts call assumption brittleness happens when a company's entire survival strategy relies on a really fragile set of deterministic variables that just completely ignore massive macroeconomic volatility. And just look at the speed of this shock. Late February 2026, hostilities break out in Iran. By March, the Strait of Hormuz effectively sees a blockade, stranding massive portions of global crude oil. By mid-April, spot jet fuel skyrockets to $4.32 per gallon. And boom, by May 2nd, Spirit is forced into liquidation. Their entire April reorganization plan was built on an assumption that simply collapsed under the weight of geopolitical reality. The math behind this collapse is absolutely staggering. Spirit's plan for exiting bankruptcy assumed jet fuel would sit comfortably around $2.24 a gallon, which would allow for a tiny, fragile 0.5% operating margin. But the actual market drove fuel up to $4.32. That single metric flipped their projected positive margin to a catastrophic negative 20.2%. Suddenly, they were burning an incremental $15 million a week just on fuel costs. In an ultra-low-cost model where your margins are already razor-thin, doubling the cost of your primary expense is mathematically fatal. The enterprise value literally goes negative. It costs far more to fly the plane than the revenue it brings in. Now, you might be wondering, why didn't this macro shock kill every airline? Well, Spirit was completely unhedged, meaning they had 100% exposure to spot fuel prices. They basically walked into a Category 5 hurricane holding a flimsy umbrella. On the flip side, legacy carriers like Delta utilized heavy options-based hedging. And get this, Delta actually owns its own oil refinery. Much like a trader buying call options to cap downside risk on a portfolio, Delta used physical and financial assets to protect themselves. They expected to recapture 40 to 50% of their $2 billion fuel headwind precisely because of this heavy armor. Spirit had absolutely zero protection. Which brings us to part two, the brutal truth of distressed equities. Okay, let's look at how this built into the ultimate retail investor trap, the myth of the government bailout. Back in late April, headlines were swirling everywhere about a proposed $500 million federal bailout from the Trump administration. Retail investors saw this and tried to bottom fish the FLYYQ penny stock, hoping for a magical government rescue. But they fundamentally misunderstood the math of how government intervention actually works in capital structures. The bailout was structured as a massive equity for debt swap. The government wasn't just going to hand to Spirit cash to save the retail shareholders, it was going to take a 90% stake, acting as a senior preferred holder.
Let's dive into the legal hierarchy for a second to really understand why this matters so much. This is the absolute priority rule in U.S. bankruptcy law. When a company fails, there is a strict, unyielding waterfall for who gets paid. Number 1, secured debt holders. Number 2, bondholders. Number 3, preferred stock. And sitting at the very bottom, number 4, common equity. The brutal truth of the market is that when a budget carrier fails, the debt holders eat the physical assets, and the common equity goes to zero. Absolute zero, every single time. If the government enters as a senior preferred holder at Tier 3, that common retail stock at Tier 4 is permanently wiped out. Secured debt gets first claim because it's backed by hard collateral, just like a mortgage on a house. For Spirit, that collateral was their physical Airbus fleet in spare parts. Bondholders, like Citadel and Aris, explicitly rejected the government's bailout terms. And why? Because they looked at the underlying math and realized Spirit's physical, grounded planes were worth significantly more to them in a Chapter 7 liquidation than sharing a diluted equity pool in a zombie airline that was still burning $15 million a week in jet fuel. History actually shows us time and time again that airlines can and do survive as operational entities while their common stock goes completely to zero. General Motors, Delta, United, they've all gone through bankruptcy in the past, reorganized and continued flying, but the original shareholders lost everything. Investors consistently confuse the survival of the physical planes with the survival of the stock. It's the classic liquidation trap, and it catches retail traders every single cycle. Let's shift gears to part 3, building the liquidity moat. Now, we pivot from the destruction of Spirit to the massive rebirth and windfall for the surviving legacy carriers. This is where the alpha truly lives for anyone watching the broader market. Look at this sheer financial fortress, what we call the liquidity moat that Delta and JetBlue built to survive the exact same energy shock that killed Spirit. Just look at Q1 2026. Delta sits on $8.1 billion in total liquidity. JetBlue has $2.4 billion, backed by over $6 billion in unencumbered assets. Spirit, by comparison, went into the crisis with less than $337 million, and almost all of its assets were already heavily pledged to creditors. A low-cost structure is absolutely no substitute for a resilient, cash-heavy balance sheet when a macro shock hits. And this brings us to the real technical alpha of this explainer, RASM, or Revenue Per Available Seat Mile. It is the ultimate metric for airline profitability. Right now, we are witnessing the complete removal of the Spirit price floor. See, there was a well-documented Spirit effect in the industry. If Spirit charged $100 for a flight to Florida, JetBlue was forced to charge $250, and American was forced to charge $500 just to stay competitive. Spirit set the floor for everyone. If you've ever scored a suspiciously cheap flight to Miami for a summer vacation, you are directly benefiting from that Spirit price floor. But with Spirit liquidating, that pricing floor completely drops out. Gone. Without that relentless discounting pressure, average fares on overlapping routes are expected to instantly climb by 20 to 23%. Plus, the 1.1% of total domestic market capacity that Spirit represented, it's permanently gone. When supply tightens like that, the remaining airlines experience a massive expansion in their unit revenue. In an industry built on scale, a 20% jump in unit revenue on existing routes is a phenomenal, almost unprecedented catalyst for profit margins. So how exactly do the surviving airlines capture this windfall? Well, it's very similar to crypto's high-frequency industrial rails, where trading bots optimize execution paths in real time. Modern legacy carriers operate with highly sophisticated algorithmic pricing. The literal second Spirit's flights evaporated from the booking systems, carriers like JetBlue immediately deployed their pricing bots to optimize yields. They instantly absorbed the demand in the exact market Spirit abandoned, capturing those higher fares with absolute zero slippage. And that leads us to our final section, Part 4, the Asset Scramble. Spirit left behind some highly coveted infrastructure, and the race to claim it is completely reshaping the map. Who gets the physical real estate? Let's check out the redistribution of these scarcity assets. JetBlue is rapidly consolidating its power at the Fort Lauderdale gates, effectively dominating South Florida's premium and leisure demand overnight. Meanwhile, United Airlines is perfectly positioned to absorb Spirit's incredibly valuable peak hour slots in New York. Just to put a dollar sign on it, Spirit slots at LaGuardia alone are valued at nearly $86.7 million. United can fold these assets right into its massive, high-frequency business network, totally bypassing years of slow organic growth.
We are witnessing a complete market transition right now. We're moving away from the past era of unconstrained growth, where ultra-low-cost carriers depended on high utilization, cutthroat pricing, and razor-thin margins. It was a highly vulnerable model. Now, we're entering the reality of 2026 and beyond, the disciplined growth era. Capacity is only added when revenue performance strictly justifies the cost. The whole ecosystem is now dominated by a few well-capitalized hub-and-spoke giants, operating with fortified balance sheets and highly optimized yields. So let's distill this entire bear-to-bull transition down to the key takeaways. Number 1, 1.1% of domestic capacity is permanently removed from the skies. Number 2, this drives a 3 to 5% improvement in industry-wide total revenue per available seat mile. Number 3, premium routes are immediately backfilled by those algorithmic pricing systems. And number 4, and this is perhaps the most vital point, legacy carriers secure these incredible scarcity assets, like gates and slots, without having to fight a single antitrust regulator in a traditional merger. They simply let the market dictate the wind down and swept up the multi-million-dollar pieces left behind.
Which brings us to the ultimate question for you, the traveler. With the permanent removal of the budget price floor and a consolidated market of hub-and-spoke giants prioritizing yield over volume, is the era of the $99 transcontinental flight gone forever? I'll leave you with that provocative thought to chew on the next time you go to book a ticket. Thank you so much for joining me for this explainer, and I'll see you next time.